So the United States has called $37 trillion of debt. At 5%, we're paying close to $2 trillion a year just in interest on our debt as this debt gets refinanced. The interest rates are going up because the probability that the US will default on its debt payments, which is what you're buying when you buy US treasuries, you're getting the US government to pay you some number of dollars with interest over time. And the market is now demanding that that interest rate be as high as 5%.
Well, you're loaning the government money. And if the government seems more risky now because of how reckless it's getting with its spending, then you're going to demand a higher return on your investment because it's riskier. That one friend that like never gives you back your money, you're probably a little bit more hesitant to loan them money than the person who's always getting you back your money. And so if you're kind of like worried that the government is being irresponsible just for the risk that you're going to be taking, you're going to want to be compensated. And that's kind of why we look at the bond markets as sort of a forward-leading indicator or even a current sentiment indicator for what the capital markets demand based on what they perceive as the risk, right? So they think the government's being too reckless. They want a higher return. That's what he's talking about.
Because of this fiscal situation that the United States finds itself in, we are now burning an additional $2.5 trillion a year, adding to our debt load.